It's not our war, but there is a war in the Middle East. We've got lower interest rates than we've had.
And oil prices have spiked and gas prices have spiked.
We are seeing bond yields start to rise.
Pretty weak economy, pretty weak labor market. But we had population decline in Canada for the first time ever.
Welcome to the Rennie Podcast. I'm Ryan Berlin, Vice President of Intelligence and the Chief Economist here at Rennie.
And I'm Ryan Wyse, Market Intelligence Manager and Lead Analyst here at Rennie.
So a semi-annual special edition of the podcast here to discuss the latest edition of the Rennie landscape.
Yes.
I know we do this every single time, and if we have devoted listeners and watchers, then we just apologize in advance that we say this little spiel every 6 months. If you don't know the podcast or you don't know the report, Rye, what is it?
So like you said, semi-annual, so twice a year, spring and fall, we produce what I think we consider to be our signature report, the Rennie landscape. So much of what we do normally looks at the traditional real estate metrics of sales and listings and prices, things like that. But the landscape takes a bigger look at all of the things either directly or indirectly affecting our local housing market. So the economy, interest rates, credit and debt markets, demographics, all the things that impact real estate, impact the economy, the sort of macro pressures that we face in our market to try to understand why things are happening. So not just what's happening, but why is the market behaving the way that it is?
Yeah. And so reading this edition of the landscape, you're probably going to feel like you're getting some whiplash, right? Because we've got inflation that's under control, essentially. I mean, it has been for the last couple of years here in Canada. We now have, it's not our war, but there is a war in the Middle East. We've got lower interest rates than we've had. They have come down over the past year plus, but we now have higher bond yields. I know what the process is like writing this report. It's a lot to begin with. On a scale of 1 to 10, given all the competing factors that are impacting the market and trying to make sense of it, how much of a headache was it this time around?
It was probably 9. So this is 2 years in a row now that the spring landscape, we started down one path, pulled all the data, ran the charts, started writing it, and then had to completely pivot. This year, when the first draft said, inflation is under control, you don't have to worry about it anymore. And then a war broke out. And now, we don't even have our first CPI reading yet since the war has broken out and oil prices have spiked and gas prices have spiked, but it will be higher.
Yeah, it will be higher. And that won't be the only reading where we see it higher, right? I mean, even if the conflict, I mean, we're in the midst of a temporary ceasefire now. I mean, even if we get a full laying down of arms and a reopening of the Strait of Hormuz, so oil is flowing again, it's going to take some time for our global supply to be flowing like it was prior to the conflict. And regardless, like when it comes to gas prices, it's, you know, as they say, it's like rockets and parachutes, right? You just look at the pump prices and they shot up. Even if crude oil markets settle, we're going to see prices at the pump come down more slowly. Diesel's still going to be expensive, and we're going to see all of that percolate into all of the things that we buy.
Yeah, absolutely. And last year it was tariffs. So we started writing it pretty normally, and then all of a sudden tariff threats started coming in and getting lobbed at Canada and other countries. And while we were writing, we didn't know if we were going to actually have these tariffs in place or not by the time the report came out. And so we keep doing this dance of like waiting, rewriting right to the last deadline. And ultimately, you know, I think it's safe to say where we are now is that oil and gas prices will be higher. Like you just said, inflation will be a little bit higher, but ultimately I think the Bank of Canada has a lot more to worry about beyond that with, you know, a pretty weak economy, pretty weak labor market, and us not knowing exactly where inflation will be for the next few months.
For sure. So let's get into this and sort of use what you just said as a segue into the first topic. So there's a bunch of things we want to cover here today. We won't go super deep on any of it because there's quite a breadth of content in this report and a lot of different storylines. I want to start with the economy. The labor market, as you said, nothing to write home about. That's kind of been the story for the past few years. The unemployment rate peaked at 7.1% last fall. Since then, it's come down nationally to 6.7%. So that looks like a win, right? Like that's directionally, you know, what we want to be seeing. But the way you've sort of address this in the report, you're sort of characterizing it as a mirage. So maybe you can elaborate on that.
Yeah, I think if you take a bit of a step back further, so we looked at the national unemployment rate for this cycle and compared it to past sort of downturns or increases in the unemployment rate. So if you look at when the unemployment rate bottomed out almost 4 years ago to an all-time low and has increased, and we compare it to past cycles, the duration and sort of magnitude of this increase has been much higher and longer than the past three, call it economic downturns. So COVID was really short, really severe. 2008 for us here in Canada was still relatively, it wasn't as sharp. The unemployment rate stayed elevated for a long time, but it was slow and steady progress through most of the next decade. And then 2001, the sort of dot-com crash actually wasn't that severe at all. Again, from a national perspective in Canada. And there's some things we should point out, like the start of this cycle was the all-time low unemployment rate. So we've had some demographic changes over the past few decades of an aging population, a lot of boomers retiring. And so these demographic pressures have sort of lowered the unemployment rate overall and have been exerting downward pressure on it. So we're not talking about like a severely elevated unemployment rate. You mentioned it. It's most recently at 6.7%. But the fact is we haven't been able to get back to where we were for almost 4 years now and counting. And the early returns in 2026 have been quite poor. So we added 200,000 plus jobs last year. And through the first 2 months of this year, and yes, the jobs data is noisy, but we've shed 100,000, 110,000 of those. So we're sort of undoing some of the progress that we've made. And all this is prior to some of the disruptions from this war. And our labor force participation has been declining. Like there's a whole lot of metrics pointing to more softness in the labor market through the first couple of months this year, whereas it seemed to be stabilizing in the second half of last year.
Yeah, it's interesting looking at this pattern of, unemployment rates. They tend to move up quickly and they come down slowly too. And I sort of look at the unemployment rate situation as like a relationship. The relationship, and you got like with a couple, it might go sour at certain points because of, there's an argument or somebody's done something to someone else, right? But it's like a thing that you can work through. If you resolve that, you can get back to, being in a better place, right? And I look at the unemployment rate, typically, like you said, there is something that precipitates a spike, right? And you go, oh, well, it was the dot-com bubble bursting, or it was the credit crisis, 08, 09, it was COVID. Not that those are good things, but you kind of go, okay, well, there were some imbalances there. And once we get things rebalanced, we know that the unemployment rate's going to come down. The labor market will settle. Yeah, I guess what's concerning about this one is just sort of like, it's like a relationship, like a couple who's just like, they're just kind of drifting apart. Like, and they're not, it's not one thing, it's a lot of things, right? Which makes it more problematic. And it's all been happening in front of us very slowly. Like, this is the frog boiling in the pot. I think people are noticing it now, but it's persisted for a long time. Like, we haven't really seen anything like this in the past few decades.
And this could continue to be a bit of a mirage. So, we'll get to some major demographic changes later, but we had population decline in Canada for the first time ever last year. We expect likely we'll have population decline again this year. And so our labor force will likely shrink a little bit this year. So we could see the unemployment rate fall without an actual material improvement in the labor market, just from simply reducing the number of workers in this country.
Which is, interesting. I mean, it's not necessarily relevant to a lot of our listeners or watchers, but we're seeing the same thing in the US, right? Where the unemployment rate there is actually quite low, a little bit of a different way of measuring it than here, but it is still relatively low. They're not adding jobs either, but the labor market's remaining tight because immigration, by some estimates, legal immigration has gone negative, right? Yeah, there's obviously a lot more than just the unemployment rate to sort of dissect when trying to diagnose what's going on in the economy. Obviously, there was a lot of noise 12 months ago around tariffs and the impact on Canadian exports, and by extension, the economy. What does that mean? We had, 3/4 of our exports, of our merchandise exports, go to the States. Now, I just looked at the data over the past 12 months through February. Our merchandise exports to the U.S. are down 16%, which is quite a bit. This is nationally. Overall, they're down 3%, but overall, they're up 2% versus 2 years ago. So it's kind of a mixed bag. There's some things to be concerned about there, but at the same time, I think in your view, maybe not as much to worry about, because of our trade agreement with the U.S. and the proportion of goods that covers.
Yeah. So 88% of our exports to the US last year still entered tariff-free, much lower than it was 2 years ago. Certainly it's, it would be nicer if it was higher, both for Canadian businesses, for US consumers for that matter. But, there are some sectoral tariffs that are quite penalizing. Obviously, steel and aluminum, softwood lumber, and, the forestry industry here in BC. But overall, our free trade agreement protected us really well last year and our businesses. And this agreement is up on July 1st. It either has to be renewed, renegotiated, or a country can choose to exit. It looks like renegotiation is the most likely path. And so this is really important. It's really important for Canada, the US, and Mexico to get this sorted. I think we will get a deal. I hope we get a deal. And ultimately, what the terms of that remain to be seen. But especially before this war started and some of the other major global events have kicked up, this to me was a really big priority for Canada, for our economy this year. I think if we can continue to have really, really high rates of goods entering the US tariff-free, ultimately, that's really important for the health of our economy.
Yeah, and for the US too. So for all of the bluster on that front, ultimately it's in the interests of both the United States and Canada to get a deal done that works for both countries, which looks similar to the agreement that we currently have in place, right?
Yeah.
Or that we did prior to 12 months ago.
CUSMA looked a lot like NAFTA before it.
Obviously, some challenging decision-making around the trade agreement renegotiation. Also, some challenging decision-making for the Bank of Canada right now. The policy rate, the overnight rate, the trend-setting rate here in Canada, 2.25%, has come down quite a bit over the past few years. It's at the lower end of what the bank calls its neutral range, where monetary policy is neither restrictive nor expansionary. That is a favorable rate for, broadly speaking, for the economy. We can work with that. We may not see it move materially over the course of the year, and that had been our outlook. Inflation has been behaving for the last couple of years, but now we do have this conflict in the Middle East. We've got globally higher oil prices. They've come down in the immediate wake of the announcement of the ceasefire. They're still higher than before the war.
30% higher.
Yeah. I mean, so they came down a lot. They're still up a lot.
Yeah.
And right now, this the ceasefire is quite tenuous. I mean, we'll see if it holds. We'll see if oil starts to flow through the strait. That remains to be seen. So the calculus around the rate decision, is more challenging right now because, as we open with, it's sort of like, what does this mean for inflation? Like, how invasive is the current oil price environment for prices of everything here in Canada? So, as you look ahead, how do you view the Bank of Canada's perspective, I guess, on this? Right?
Yeah. And like you said, at the start of the year, we expected they would sort of just hold maybe through the entire year as inflation was under control, as they finished last year where they wanted to be at the lower end of their target range. We have 2 months of data on the labor market, on inflation. So again, we don't have the March inflation data yet. And the first 2 months of the year, actually, like we already said, the jobs data was quite poor. And inflation actually came in a little bit cooler than some had expected, than the bank had expected. So headline coming down to 1.8%, a little below their target. Core measures coming down to 2.3, the lowest they've been in quite some time. And had it not been for the war and for rising energy prices, I think the conversation would have shifted to, should they actually cut more or not? Of course, we didn't get this data until the war had already started. So there's like a weird timing thing where we found out actually we were in a different position than we thought we were. And then, of course, everything has changed. If it wasn't for high energy prices, which, again, a central bank can't control the price of a globally traded commodity, I think the conversation would have been, should they cut a little bit more? Now they have to deal with prices of all goods having higher transportation costs and some of that moving through. And so I think probably what they're going to do for the time being is wait. They're going to watch. Again, we don't have a CPI reading yet. We don't know if this ceasefire will hold. There's a lot of things that no one knows. So the next announcement, I believe, is April 29th. I think they'll probably hold there.
I'd be shocked if they moved in either direction.
Yeah. And so I think ultimately what we're going to see is a very cautious approach from the Bank of Canada. The language in their last release, I would describe it as a hedge. They acknowledged a lot of downside risk at home, upside risk from high energy prices, and a need to just see where this goes. No one knows how long this situation will last for. And so I think ultimately we're just going to see the bank be super cautious for the next few months.
Yeah. I mean, to the extent that it is a transitory effect, like, and by that, I mean a multi-month, 3 to 6 month kind of impact on the economy. The bank is not going to want to jump in and adjust monetary policy to reflect that, right? Because again, we have this like underlying slow growth in our economy. We are seeing bond yields start to rise. That is going to spill over, if on the expectation of higher inflation, and that will spill over into higher mortgage rates. Yep. On that topic, mortgages and debt, you have a really good chart in the report showing the death of the 5-year fixed mortgage, or if not the death, the waning prominence of it. Yeah. So as borrowers renew right now, like usually the 5-year fixed rate is like the go-to, right? What are borrowers doing now?
Yeah. So increasingly, they're not choosing the 5-year fixed rate. So we back up. You and I have been talking a lot on this podcast and other areas about the mortgage renewal wave that's been coming. And a lot of people have been saying, it's this cliff. It's going to completely change things. Watch out, because in late 2025 and then through 2026, we have all these renewers renewing off these ultra low rates they got from COVID when they took a 5-year fixed rate at sub 2%.
I was one of those, and it sucked.
Well, for 5 years, it was great.
For 5 years, it was really good.
Yeah. And one of the things we've been saying is that thanks to the stress test, the much maligned stress test, our expectation was that people could afford these renewals. Rates were only a little bit higher at renewal than where they were stress tested to. Yes, costs have gone up, but so have incomes. And so I've thought, and I think I won't speak for you, but I think you did as well, that overall Canadian borrowers as a group would be able to handle these renewals, even if it's painful, like your
There's
renewal.
a difference between not being able to afford a rate increase and not liking a rate increase. So
exactly.
Most people are in the latter bucket.
And those in the latter bucket have taken another step, which is going from a 5-year fixed increasingly to a 3-year fixed. Some have chosen variable. And so the share of all outstanding mortgages that are in 5-year fixed rates has come down to a low. The data set goes back about 10 years, so it's not super long term, but the lowest we've seen. And the share of it says 3 to 5 years, so 3 and 4 year fixed, mostly 3 years, has really, really grown. So in 2021, share of outstanding mortgages that were 5-year fixed was about half, so 50%. And it's come down to 23%. So it's been cut in half. Yeah. Yeah. So 3-year fixed rates have been materially lower than 5-year fixed. So you're trading that extra 2 years of security for a lower rate. And that, I think, is a calculus that a lot of renewers and probably some buyers as well are choosing. I think it makes a lot of sense for a lot of people. We don't know. Where bond yields are going to go over the next few weeks with so much, uncertainty globally, but we certainly don't know the difference between where bond yields will be in 3 years versus 5 years. So I think that upfront savings or mitigating that rate increase a little bit makes a lot of sense for people.
Indeed. Speaking of people, in the category of terrible segues, let's talk about demographics.
Yes.
Okay. So this is this is juicy stuff. So over the past year, and I will say, we predicted it. We did. I mean, it wasn't like a crazy wild prediction. It was predicated on the government adhering to its own policy, but it was definitely a forecast at the start of 2025 that was outside of the main. And what am I talking about? I'm talking about the population decline in 2025 nationally that we had expected. It came to fruition. Canada lost 102,000 people over the course of last year. The first time that we've seen a net loss in people in this country since Confederation. So that's a biggie. And then in BC here, this province shrunk by 41,000 people. So that's a lot, right? Like, we just don't see that kind of magnitude in that direction. Again, largely almost entirely reflects the impact of the government pushing out non-permanent residents, not approving as many permits. So we saw a big decline in international migration. Permanent residents were still elevated, still in line with recent historical counts and in line with the targets. So here in BC, for only the second time in this province's history, so this is going back to 1874. I didn't have to look at my notes. I knew.
Yeah. So
I knew
we've
1874.
been a province since 1871. And in 1874, we had a very small population loss and then
Indeed.
population growth every year since. I looked it up to see if it was like the
You didn't just know that?
No.
I knew that.
Did you? It wasn't the end of a gold rush. That was going to be my guess. So there wasn't a pandemic or any major factor influencing why we experienced population loss in 1874.
Okay. Well, we don't know the why, but we know the what. So it's been a long time.
Yes.
And BC lost 41,000 people on a net basis last year. So what happened? Where'd everyone go?
Yeah. So a whole lot of non-permanent residents left. So international students, temporary foreign workers, the international mobility program, as per the federal government's new policy, a lot of permits expired and people left. So we lost more than 80,000 NPRs from BC last year, and we still added 35,000 PRs, so immigrants. But the much larger NPR share sort of washes everything else out. We had a very small natural increase, so we had a few more births than deaths province-wide last year, and what flipped back to positive interprovincial migration by a small amount. So we'd had about 18 months of negative interprovincial migration, more people leaving BC primarily for Alberta than people moving to BC from all other provinces. And so that's back to positive again. We're still getting a lot of people from Ontario. But again, those are much smaller numbers. It's the 80,000 that really matters here.
That being the specific source of the decline, again, speaks to the impact of the policy. But given that it is confined to, those losses are confined to the policy space, and we know the government is pushing to sort of put a bow on this particular part of the immigration levels plan by the end of 2027, which is to say, at that point, they will have hopefully hit a target of NPRs being 5% of the population, which means we don't need to be on this aggressive trend of not bringing in as many people and pushing people out. And so from there, that should stabilize growth.
There's actually been a change within last year. So the first 6 months of last year, there wasn't a lot of progress made on this new target. And most of the decline happened in the second half of the year. And part of that's probably the university calendar, with fewer students coming in August, September, and more leaving in the summer. But we're actually further ahead than expected on progress nationally. So if we continue at this pace that we saw in the last 6 months of last year, we'd actually hit the target by the end of this year. So either they can slow down or finish sooner and then resume some level of pre-pandemic population growth. But you mentioned whiplash at the start of the episode. Like this, all of these policy changes, these immigration policy, these non-permanent resident policy changes are giving us whiplash as well. We went from stable growth to explosive growth to population decline. At some point we will get through this, and hopefully we can have more stability when it comes to our immigration policies, to our population growth.
Right. We were taking population XLAX, and now we're on population Metamucil. Okay, let's bring it to the more local region and market. So we do have a shrinking population. We don't have the full year Metro Vancouver numbers in yet, but safe to say, given what we saw nationally and provincially, that would have played out here. Our expectation was that there would be somewhere between, I think, 15 and 20,000 people net loss for Metro Vancouver this past year. So
NPR's non-permanent residents disproportionately live in Metro Vancouver within the province. So if anything, we could have underestimated that.
We could have. I mean, given it was 41,000 provincially for sure. So we have a shrinking population. We have a housing market that's characterized by conditions favorable to buyers. We started the year with 11 months of inventory. It's come down a little bit. But I don't think we need to, if we sort of think about the impact of this on prices, we don't need to twist ourselves into a pretzel, right, to understand or to guess what's happening there with home values.
Yeah, we did it's almost like a thought experiment. So we ran some numbers and we said, what would it take to get to the bottom of a balanced territory or into seller's market territory? So if you start the year as a buyer's market, pretty elevated, and we know where inventory is, and we factor in the seasonality of inventory, how many sales do we need to achieve to draw inventory down and to get that dynamic to 5 months of inventory, which is the line between sellers in balanced territory. And the answer is, for the Vancouver region, 55,000 sales, given where we started the year from an MOI perspective and from an inventory perspective. And the likelihood of achieving that level of sales this year is nil. So we can safely say that we wouldn't get to that place where you could expect pretty substantial price gain. Again, when you get into seller's market territory, that can be significant price gain. When you're in balanced, you can get
you still get modest,
some. Yeah. And you think about it as like balanced territory might get you something like inflation for your price increases. And so sellers would be beyond that. But that is so many more sales than we're expecting this year that we're projecting some more price declines, especially in the condo space for this year. So
to what extent?
4%.
Right.
So not massive, but another 4% decline on a couple of years of declines, I think, is significant. So we expect to finish the year 86% of the previous peak value,
which was spring of 2022. Yeah. So that's like a 4-year, like by the end of this year, if that's where we end up, we're coming up on 5 years off peak. So we know within housing too, it's not just the ownership side of the market that's feeling the heat. It's not necessarily a bad thing. I mean, it's more challenging conditions for the supply side of the market. For renters, tenants, conditions are certainly more favorable than I can remember them being, over the past 2, 3, 4 decades. In fact, the overall vacancy rate as of the end of last year in the purpose-built space was up to 3.7%. So the highest we've seen since 1988, up from 1.6% the year prior. What's driving that?
So we just talked about demographics, non-permanent residents. So we just saw 80,000 non-permanent residents leave the province. They're overwhelmingly renters. So there's a reduction in rental demand from all those non-permanent residents leaving the province last year. At the same time, we delivered a record level of new purpose-built rental supply. There was over 11,000 new purpose-built rental homes delivered last year across the region. So we've chatted about this, I think last month even. There's like a mismatch in terms of we're delivering all this new supply at the same time that a lot of people are leaving. And so that's part of the reason that the vacancy rate has increased from, for so long in this region, it was too tight and it was really challenging for people to secure housing, for turnover rates were suppressed. And so I think that, there's some it's healthy that we're adding so much new supply, but it's also made things a little bit challenging as we're delivering it because the vacancy rate isn't distributed evenly across the region, of course. And where we see it the most elevated is at the top end of the market. So we segmented in the landscape vacancy rates by rent quartile. So the top quartile has the highest vacancy rate, which makes sense. The most expensive homes are often more challenging to lease out. There's not as many people who can afford those leading edge rents. And so that matters a lot for the new purpose-built rental market, for developers who are bringing new supply in order to get their buildings leased up and stabilized. It can be a little bit more challenging in a market like this, where that leading edge rent has a higher vacancy rate and there's more competition amongst those buildings.
Definitely. And that's likely to, more or less characterize the market in our view, over the next year and a half. And at that point, we do expect to see some changes because we expect new rental supply to wane. We expect population growth to return. And so that does speak. So you look longer term, the demand for housing is still there, like whether it's rental or it's ownership. We just conducted a survey across Metro Vancouver, Victoria, and the central Okanagan. And as part of that, we found out that, more than a third of the people that we surveyed said they intended to buy a home in the next 3 years. So obviously not all of them. You expand that into the population of these regions is not going to translate to a transaction for each one of them, but the desire is still there. The conditions maybe aren't supportive of it right now. So there's a lot to sift through, to synthesize, very, very challenging market to participate in, but then to understand, right? For all of us, like whether we're in the industry or we're not, if you're just someone looking to buy a home or rent a home, there's a lot of noise out there. So thank you for helping us sift through that noise and find the signal in there by writing the rennie landscape. For everyone who's listening or watching, if you'd like to dig into some of the data and the charts and the commentary that informed our conversation today, you can go to rennie.com/intelligence and you can access the rennie landscape spring edition 2026 there. Rye, thanks for doing this again.
Thank you.
It was a good conversation.
We'll see you in the fall.
Really?
Well,
we'll see you this afternoon.
Okay.